Good morning, everyone. I am Nelson Ribeirinho. I have been a portfolio manager for 3 years now at Mirova. First, a little bit of history about Mirova. Mirova is part of the Natixis Investment Management Group as one of the 28 affiliates of the company. Mirova is a pioneer in ESG. I'm sure that you have pretty much witnessed so many pioneers that you lost count in terms of ESG. But the thing is that Mirova was created as a fully fledged ESG player dedicated to sustainable finance in 2014. It has been the case since 8 years now, and we are also qualifying as a mission-driven company as per the French law Facto 2. So it is written down in our statutes, in our legal statute as a company, that our purpose is to basically maximize environmental friendly initiatives. So at Mirova, there's no question asked. 100% of our funds are Article 9. That's pretty much the start of everything at Mirova. We have decided at the very beginning of the company to boost our capability in terms of ESG, mobilizing as many as 16 ESG analysts from 2014 onwards. And from that point onwards, the idea for us was to basically set up as many funds which are Paris aligned, so below the 2-degree target of global warming scenario. Today I'm here to present you the green bond strategy. It's actually a great timing because yesterday there was a report by the IPCC, which is an international body in charge of measuring the climate change, which was basically saying and telling us that we were like 3 years left before we reach the peak of our carbon footprint. So we have pretty much 3 years ahead of us to reverse the cycle and to reach the inflection point. That would be it, in my view, for the Greta Thunberg moment. But the idea with the green bond product that we are basically offering you today is to take the shortcut toward the 1.5-degree global warming target. Knowing that at 2 degrees, some of the biggest cities like Dubai, Miami are basically getting below the sea level, so they are going to be just basically flooded. So what we are offering you today with this green bond strategy is probably the best way in the fixed income liquid world to optimize your carbon footprint and basically minimize your impact. And for that, once again, we used our capability as ESG investors. And the idea is to use a very straightforward approach to sort out the universe and to be, on the one hand, exclusive and on the other hand, inclusive. So there it is, our ESG scores. It ranks from negative to committed. Negative on the left-hand side. Anything negative or risk is excluded out of the scope, and it represents as much as 60% of the green bonds. So at Mirova, we are excluding 60% of the green bonds on account of poor practices, low standards, low ambition, but I come on that afterward. The idea is also to prioritize the positive and the committed, and that's basically how we get to the Article 9 for all our funds, including the green bonds. The positive and the committed ESG scores, which are basically 4 and 5 out of 5, make up a minimum of 70% of our asset under management. So that's a run rate, but that's really seen as a minimum for us. And in the case of the green bond strategy, that number would not be 70%, as is the case for most of the funds at Mirova, but above 90%. Above 90% of the global green bond strategy is basically positive and committed for the environmental transition. How do we get to this ESG rating, ESG scores? Well, we use pretty much a life cycle approach for what concerns the conventional bonds, based on a qualitative and absolute approach, which is basically overseen by as many as, once again, 16 ESG analysts, which are internal. We are double-checking everything. As investment manager, we thought that our fiduciary duty was basically to challenge any green bonds, any self-labeled green bonds, because you might know for a fact that all the green bonds are self-labeled. So any company can come up and basically say, hey, I'm issuing a green bond you should take it as granted, but that's definitely not the case. So we are here basically to conduct a thorough review of the green bonds so that we avoid, obviously, greenwashing, which is the buzzword as of today. And how are we performing that? So basically at Mirova, we have been a member of the Green Bond Principles for more than 10 years now as a steering committee. Steering committee is a Green Bond Principle jargon for executive committee. So we are a board member of the Green Bond Principles, and the idea from that point on was to basically try to make a change, because green bonds are to generate positive additionality, and for that you need to put in place some safeguards. And those safeguards are basically detailed on this slideshow. We have 4 pillars. The first one is the use of proceeds. You might know that a green bond is a very straightforward instrument. It's very plain, it's very simple and efficient. The idea is to redirect the proceeds towards green assets. Green assets which are self-qualified by the issuer. And that's basically where the problem lies. Everything is safe-labeled, so we have to double-check that through the use of proceeds first. I mean, we need to generate opportunities there. The other day, there was an aluminium producer called Ardag, which launched a green bond. And the idea was to say for them that basically the proceeds were 100% allocated to green assets for the very reason that they consider their activity was 100% recyclable, because aluminium, you might know it for a fact, is 100% recyclable infinitely, basically. But that's not something which is creating any additionality for us. It's not creating a change. It's not really making a difference. So that very specific bond for us was excluded. And then we have also the possibility to look into the process of these green bonds through the evaluation, the selection of the assets. You pretty much need 2 years to build a green bond framework from the ground up. 2 years is a lot, but for that you need a green task force. For that you need to screen the whole balance sheet of a company. So it takes time, and you should not really budget it as an issuer. And sometimes, unfortunately, it happens. And then in terms of management of proceeds is basically where is the money going to? So we have to double check that once a green bond is issued, the proceeds are well reallocated to the green assets and not to any other project, especially when they are affiliated to greenwashing. And then reporting. Reporting, in our view, is the name of the game. I mean, reporting is something that should be used as a universal language. Anything should be translated into carbon footprints from scope 1 to scope 3. So the full spectrum of the impact has to be covered there. So we excluded names, for example, the Japan Development Bank, because of this regular reporting inefficiencies. They were not making any calculation, any measurements. So for us, that's basically out. So to perform this analysis, which basically allow us to get granted some labels, like the Fabelfin labels in Belgium, the Greenfield label in French, or the Ogut label in Austria, just to name a few. We are basically proceeding to an engagement, ex ante and ex post. So we get in contact with the issuer. We are supposed to engage with them so that we can fine-tune their project and try to make a change for good. Because once again, the idea there is not to invest into a green bond, which is refinancing a project that would have been refinanced anyway. It's to refinance something which is brand new, which make a change and which basically boosts the capex redirected toward this well-known green financing gap, which is around 4 trillion a year, a minimum. Then we have access to the primary market, of course, and for the primary market stage, the idea there is to measure greenium, because greenium is another name of the game along with the regular reporting. At Mirova, we think that as investor, we should not overpay for green bonds because it's basically bearing the very same risk as a regular issuer or as a conventional bond. So We are calculating, and each and every day a green bond is issued in the market, the greenium that is supposed to be priced in, and the idea for us is to avoid it. So we are setting the limits during the primary dealing process. And then during the post-issuance engagement, well, that's mostly our job. 80% of our efforts are concentrated on the post-issuance engagement. So we are basically verifying that everything is in line with what was pledged during the first contact of the primary issuances. So to get into the details, and basically this slideshow is detailing our job. I mean, we are excluding 60% of green bonds on many accounts. First one is to avoid ESG risk. I just named ARDAG, but you have other names, obviously. Exclusion of controversial activities. So just to do a bit of a name dropping, Saudi Arabia, Russia, and China are basically out of scope. Exclusion of low ambition framework. So at Mirova, how are we making impact in terms of ambition? Well, take an example like the green buildings. The green buildings, there is what I would dub a jungle in terms of labels. There's no harmonization whatsoever at the international levels. So the idea that we got at Mirova was to focus the green bond investment into the top 5% of the green buildings as per their label grade. So for example, if I take BREEAM, if I tell LEEDs, it has to be excellent, very good, gold, or platinum. Anything aside that is not eligible as per Mirova's framework. So we're excluding as much as 50% of the green bonds which are financing green buildings because of that rule of thumb, I would say. And then the limitation of OPEX financing. I mean, OPEX, it goes on and off. OPEX basically means single use. Single use is not sustainable. We should redirect our firepower on CAPEX, because with CAPEX, you're really improving the current situation and you're generating new assets which are basically more in line with the transition. Take the example of Starbucks, for example. Starbucks, they issued a green bond. That green bond was basically meant to finance cups made out of recycled plastics. I mean, in our view, that's not what it should be. We would be more willing to finance a machine which is basically building reusable cups, unbreakable cups, which you buy once and for all, sorry, and you avoid consuming maybe 20 recycled cups issued by Starbucks. The idea is there. We want to get a long-term approach to our investment. Then we have the exclusion of the fossil fuel energy, because, come on, we have to look at the big picture. I mean, let's take French oil and gas company Total Energy. I mean, they rebranded the company, which is good, but that doesn't change a thing. They decided to prepare a green bond framework to finance wind turbines, to finance solar panels, but at the end of the day, if you look at the big picture, Total has no intention whatsoever to reduce the oil and gas extraction or exploration, maybe in Europe, because there's basically no more reserves, but in our part of the world, in our view, we should not invest into green bonds of Total. You should buy Total because they won't reshuffle the cards, as did Ørsted in Denmark, for example. Ørsted, which was previously known as Danske Oil and Gas Companies, they decided to give up on 90% of their high carbon emitting activities to switch to full renewables, or at least 90% renewables. That's what we want. We don't want companies that are opportunistic about the green bond market. And then there's avoiding also some strategy which are not in line with the 2 degrees. Take what I would call the Carmichael mine gate. There was like 5 or 6 green bonds related to the Carmichael coal exploration in Queensland, Australia. These guys, they came out with green bonds, quite good green bonds, by the way, because they were like really into clean transportation, railways, but at the end of the day, we discovered that these railways were basically used to transport coal out of the mine. And the same applied also to an Indian bank, which is called State Bank of India, which is part of the Adani galaxy. they issued 3 or 4 green bonds out of that to finance strategies which are green as taken on a standalone basis, but not so green when you look at the big picture. And that's also our job, looking at the big picture, looking at the life cycle. So I talk a lot about greenwashing, but there's also positive inclusion, obviously. And positive inclusion is favoring the best green bonds out there, especially in terms of renewable energies, green buildings. So we have many examples about that, but the idea is to have a very disciplined approach in selecting the green bonds. What we want is obviously to get in line with the 1.5-degree target all the time on a run rate basis, and for that we use a tool which is called TCSO, and TCSO is a tool that allows us to identify trend, challenge, solution, and opportunities into each and every sectors, making Mirova's taxonomy. Because something that I haven't really mentioned is that Mirova was involved during the technical expert group of the European Union in the taxonomy discussions, in the SFDR discussions. So that's also a way through what I would call public relations that we try to make a change. We want to be part of bodies, we want to be part of labels, so that we become the greatest common denominator of ESG. And to ensure and to get the Article 9 funds as green lighted. So these are many examples, bad examples worldwide of companies that were greenwashing. But the idea, I mean, is what I was mentioning before. I mean, we have to be very thorough about that. If you start with the beginning, which is high ESG capabilities, many people's double checking, you are able to avoid that. And about green bonds, we are very proud that the EU taxonomy came up, but apart for 2 exceptions, nuclear and gas. Nuclear and gas for us are not necessarily part of the green bonds. A green bonds financing nuclear or gas is ineligible at Mirova as green bond, and it should stay this way. So taxonomy is a very good thing, but once again, it will not prevent for us greenwashing. I'm more like the half-full cup guy when it comes to taxonomy. I'm very enthusiastic about it. It is also a great opportunity to differentiate from nuclear and gas and the remainder. So I would not do a bashing about the EU taxonomy as some of my peers are doing, especially in the green bond world. I think taxonomy is a very good thing. And we are at company level deciding to basically exclude nuclear and gas from the reporting that we are requiring from investors. Yeah. No, I mean, I think that the green bond product is a very good call for us. It's the shortcut toward the 1.5-degree alignment. I mean, I'm sure that many people are laggards in terms of ESG transition. Well, you should just take the shortcut and go to the green bond impact investing strategy.
Thank you, Nelson.
Yeah. Thank you so much.